Good afternoon, everyone. Thank you for joining today's webinar. Before we begin, we'd like to cover a few webinar housekeeping items. If you have any questions during the webinar, you can submit your questions through the Q&A window and we will reply to you by email after the program. Today's webinar slides are available in the event resources window on your console. Additional materials are available in the same file. This program is eligible for CLE and CPE credit in the jurisdictions we serve. Throughout the webinar, you'll see several poll questions pop up on your screen. In order to ensure that you receive full credit, please respond to each question and click the submit button inside the pop-up window. You'll have 2 minutes to do so each time a pop-up appears. A recording of today's webinar will be available tomorrow at the same link you used to register for today's program. With that, we'll begin today's presentation. We have for you today a special crossover presentation from our New York and New Jersey webinar series. The topic today is a combined reporting face-off, New York versus New Jersey. Our speakers today are myself, Jennifer White, and my colleagues Aaron Young, Matthew Setzer, and Dave Katowski. Aaron and I will be focusing on the New York portion of the presentation, and Matt and Dave will cover New Jersey. With that, Dave, I'll send it over to you to kick things off.
Okay, thanks, Jen. So our inspiration for today's program was actually a children's book. It was the Who Would Win series, where they would pit two different wild animals and analyze each of the attributes, such as speed, size, strength, and see who would win in a hypothetical battle to the death. And we got to thinking, what if we were to do that for New Jersey and New York? Not necessarily who would win in a battle to the death, but which state has a more taxpayer-friendly, a more favorable jurisdiction, for taxpayers to do business in. And we thought it was appropriate since they both recently adopted combined reporting, New York in 2015, and New Jersey combined reporting became effective in 2019. So over the next hour, we're going to go through and analyze 5 different attributes of each of the state's rules and compare them and see which state has more restrictive or more taxpayer-friendly rules, and take a deeper dive into some of the opportunities and exposures that each jurisdiction has. So with that, let's get started. And the first attribute we're going to take a look at is determining who is or who isn't in your combined group. Aaron, do you want to start us off with New York?
Yeah, so for New York, we're going to talk about the new, and I'll say new, even though they go back to 2015, the new combined reporting rules for New York, how the group is constituted, some various elections that you can make, and then compare and contrast to sort of the old New York law, which was in effect for years, which resulted in a lot of litigation, a lot of taxpayer uncertainty. So that all changed effective January 1, 2015. So we're going to compare that to New Jersey's combined reporting regime.
Right. So New Jersey flirted with combined reporting for a couple of years before finally pulling the trigger, effective in 2019. New Jersey's rules are fairly consistent with other states. You essentially have 3 choices. You can either file under a water's edge election, worldwide election, or use your federal affiliated group election. There were about 5,000 combined returns filed last year, and overwhelmingly, taxpayers chose water's edge, which is the default election. Only about 5% of taxpayers chose the affiliated group election, and then fewer than 100 chose to do worldwide reporting. And that's not too much of a surprise because for most taxpayers, an affiliated group election really doesn't provide a lot of benefit. And I think because the election continues for the current and 5 following years, I think taxpayers were a little concerned about jumping in with worldwide reporting, in the first year. Some things that set New Jersey a little bit apart from other states is its very broad nexus rules and how those nexus rules are incorporated into water's edge election. In New Jersey, making a water's edge election doesn't necessarily mean water's edge. If you have foreign affiliates that have nexus with New Jersey, they're brought in as well. And the problem is New Jersey's nexus rules are very, very broad. No physical presence is required, and even intercompany services that generate receipts that get eliminated can be sufficient to create nexus. And that's what sets New Jersey a little bit apart, even on the affiliated group election. That's not necessarily limited to your federal affiliated group under recent legislation. That can bring in other affiliates as well. So let's talk about, Matt, Aaron, did you have something?
Well, just to add a little bit to that, I wanted to go through the New York regime. So prior to 2015, and I guess we'll talk about, since a lot of taxpayers still have open audits under the old rules, the group composition prior to 2015 was separate company reporting, even though many, if not most, taxpayers for corporate tax purposes in New York filed combined. There were rules regarding how that group was constituted and related to unitary reporting or unitary business ownership test, and the primary test was what was called substantial intercorporate transactions. So there was a presumption of combination and distortion if you had substantial intercorporate transactions prior to 2015. That created the combined report in New York, and of course you had a lot of litigation in New York that related to whether or not there was distortion, either for decombination purposes or combined reporting purposes. There were, cases being litigated for probably the last 20 years. The most recent being Sherwin-Williams, the Kellwood case, the Hallmark case. So to avoid those problems with substantial intercompany transactions, forced combination, forced decombination, New York went, I think, into a more typical combined reporting regime based on unitary reporting. And that unitary reporting basically requires all unitary entities to file in a combined report. Alien corporations, which were not permitted to be in the combined report prior to 2015, were now permitted so long as they were had effectively connected income or were deemed domestic corporations. And for unitary purposes, New York did not have a lot of unitary guidance, and still doesn't, because of its prior regime was really based on distortion more than unitary tests. So the common rule right now for New York is really just U.S. Supreme Court guidance regarding the 3 unities test and the Mobil Oil U.S. Supreme Court case.
Okay. Should we go to the next slide and talk about some of the exposures and opportunities? Aaron, do you want to start?
Sure. So there is a presumption of unity in New York now for filing combined. You can file your combined group by also making a unitary election. So even if you have entities in the group that are not unitary, you can make an election to file combined nonetheless. That election is unrevocable for 7 years. And if you do revoke the election, you can't re-implement the election for 3 years. Holding companies are now deemed unitary. So prior to 2015, there was a presumption in New York that holding companies were not unitary. And that, of course, created certain tax advantages and strategies. Now there's a presumption that they are unitary and should be in the combined group. There's also the issue of, and we're going to get into incentives and some special tax rates further on in the presentation. But when you look at the combined group to qualify for incentives, such as the manufacturing zero rate, you have to look at the combined group's receipts and the combined group's manufacturing property to determine if the group itself can claim that rate or not. So whether or not a taxpayer wants to make this unitary election, whether they want to make a non-unitary argument and try and exclude certain entities in the group, that is possible. And again, it's somewhat flexible in New York because of the lack of case law regarding unitary business in New York. So there are some planning opportunities related to the group, although it's certainly much simpler now to file combined compared to prior years in 2015, when New York was using this substantial and corporate transaction regime and distortion there was more conflict between the department and taxpayers regarding how to constitute the group. The issues also flow into New York City, which has its own corporate tax. New York City's law is substantially similar to New York State's law. So typically, if an audit issue is raised at the state level, it's also going to apply to the city and vice versa. That said, the city does not have to follow state treatment. And in fact, we've handled combination cases where New York, for example, accepted the combined group filed on audit by the taxpayer, and New York City was forcing combination with another entity that wasn't in the original filed group. So you can have different outcomes in New York State and New York City, even though they're using substantially similar tax laws and tax authority for combined reporting purposes.
Okay, so on the New Jersey side, what are the opportunities and exposures? First, I mentioned how New Jersey has a broad nexus standard and can even bring in foreign affiliates into your Water's Edge group. Although that can be an exposure, it can also be an opportunity. If you've got some foreign affiliates that aren't generating a lot of income but have a lot of foreign receipts, it's easy to trip into Nexus into New Jersey and bring them into the group where you're going to get factor dilution and not that much, relatively speaking, of a bump to your tax base. So that's something to consider if you want to do essentially a worldwide reporting, but only on a limited basis. You can almost cherry pick out certain affiliates to bring into your group. On the other hand, one exposure that is a problem is if you're 86272 protected. The division's policy is that after combination, 86272 really no longer exists. And the reason for that is because the rule is such that if one affiliate has physical presence in New Jersey and exceeds solicitation, then any other affiliates that are part of the combined group can't claim 86272. And although, as a technical read of the statute, there's support for that, I don't think that's what New Jersey intended in terms of the legislature. They had an opportunity to adopt Finnegan and they rejected it in favor of Joyce. So, this interpretation of the statute, I think, goes beyond the intent. So if you're impacted by this, let us know. We're looking to see whether there's support for a coalition to challenge this policy. So, given what we just discussed, Aaron, who do you think has the more taxpayer-friendly, rules?
Well, yeah, and I mentioned that New York had a fairly difficult, sort of obscure method for combined reporting prior to 2015. So I think prior to 2015, I think New York would have lost this one. Now they've attempted to streamline their combined reporting, make it more typical to other states, using a unitary test. There's no longer distortion. There's no longer substantial intercompany transactions. They do have a couple hiccups, that I mentioned. Alien corps can now be included in the combined group, but to the extent they have effectively connected income, that's computed without regard to treaty protections, for example, if the treaties aren't state specific, and most of them are not. They have an economic nexus standard now, which they didn't have prior to 2015, which is also pretty common in some other states as well. So I think overall, New York might have a more taxpayer-friendly combined reporting regime currently, even though they didn't prior to 2014. Okay,
well, New York wins, that component. So let's move on to the next issue. Jen, you want to take this one?
Yeah, of course. NOLs and dividends. So let's see if New York can keep the lead going. Beginning 2015, New York completely revamped its NOL regime. NOLs are now carried forward and backwards on a post-abortion basis as opposed to a pre-abortion basis. And in line with this change, NOLs are no longer subject to the federal limitations, such as the source year limitation rule and the federal cap. So these are definitely positive changes, as those restrictions really limited the use of a lot of New York NOLs for many taxpayers in prior years. We've also now got, in addition to the NOL, the PNOL, or the prior net operating loss. Basically the state's way to convert and monetize NOLs that were in existence at the time of corporate tax reform. The PNOL rules are, again, I think relatively favorable because they breathe new life to NOLs that were set to expire. So the carry forward period for the PNOL, it's not based on the age of the NOLs used to compute the PNOL. So both NOLs and PNOLs can be also fairly liberally used to offset the income of other entities within the combined group. So pretty good attributes there. Dividends, New York provides a deduction for dividends that are classified as investment income, although this isn't much of a benefit since investment income isn't subject to tax. And New York's implemented a pretty limiting rule of what qualifies as investment income, which also includes really onerous record-keeping requirements, which are pretty easy to foot fault on. CFC income and exempt unitary dividends are also deductible. I'll mention that guilty and deemed repatriation, so some guidance there. For both New York City and New York State, exempt CFC income includes deemed repatriation under 965. However, interest attribution must be done in order to subtract interest deductions from the exclusion. And then effective January 1st, 2019 in New York State, exempt CFC income includes 95% of guilty. So that's, pretty favorable compared to some other states. And we're not focusing on New York City today, but it's definitely worth noting that rule is not the same for New York City, who does not provide an explicit deduction for guilty. Matt, what about New Jersey?
Yeah, so there's some similarities and some differences between New York and New Jersey here. I think just like New York, there's now two NOLs in New Jersey. You have both a group NOL and a prior net operating loss. So you have a PNOL in New Jersey, a little bit different than a lot of other states, and that's something these two states share. A difference, though, is when the legislature shifted to from pre-apportioned NOLs to post-apportioned NOLs in New Jersey, it was a significant change. And like you said, Jen, in New York, the legislature had to account for how to monetize all those pre-apportioned NOLs. The New Jersey legislature had to do the same thing. Unlike New York, though, your PNOL calculation does not resuscitate the carryover period. So there's no revival of that carryover period in New Jersey. There's some restrictive sharing rules in New Jersey for NOLs. Generally, if you're part of the same combined group as other members, you can share your group NOL. The PNOL is limited to the member that generated that PNOL. And then in addition to these new rules for NOLs, the legislature also had to account for some historic NOL rules in New Jersey, such as the merger rule. And the historic merger rule in New Jersey generally provides that if you were involved in a merger, any NOLs you generated prior to that merger were lost as a result of the merger. That no longer is the case for combined groups. So if you have members of a combined group that merge, they don't lose their NOLs that were generated prior to the merger. Same thing with the PNOL. You could have members that merge. The PNOL will not be lost either. So I said that there was a restrictive sharing rule for the PNOL, but hypothetically, you could merge with another member that has a PNOL, and that PNOL would not be lost. It would be attributed to the member that you merged with. And then there's the historic NOL dividend ordering rule. I think it's probably everyone's favorite rule in New Jersey. And what that calls for is generally in New Jersey, you would take your net operating loss deduction before your dividends received deduction. So your net operating losses are diminished by the dividends that are in your entire net income in New Jersey. That changed at the time of the first enactment of combined reporting in New Jersey, and then it shifted again. So there's still this historic NOL dividend ordering rule, and we'll get into the next slide how to account for that historic rule. So I think what you see in New Jersey now is you have a mix of old and new rules, and taxpayers need to account for both those old and new rules and see what rules are more taxpayer friendly and what rules are more so tax administration friendly. So moving on to exposures and opportunities, Jen, do you want to kick this off for some exposures and opportunities for New York-based taxpayers.
Yeah, of course. So the first one is, to definitely pay some real attention to the computation of the PNOL. And I think obviously this will be the case in New Jersey too, but the basis for the PNOL calculation is unabsorbed net operating losses in New York, as well as the source year BAP, which is basically a taxpayer's apportionment in 2014. Leading into 2015, so many taxpayers' NOL schedules were a mess, right? Especially if they hadn't been using their NOLs lately or had what they thought were, voluminous amounts of trapped NOLs. But all of a sudden, they're brought back to life, right, through the calculation of this PNOL. So it's definitely worth a thorough review to ensure that all unabsorbed NOLs, which are NOLs on the books that are available for carry forward, have been identified so that they can be properly monetized as this, really favorable new deduction, I think. NOLs that taxpayers thought were trapped due to surly rules, for example, all of a sudden can become really valuable. The second part of the computation for the PNOL that presents an opportunity is the 2014 or the base year BAP. Obviously, the higher it is, the greater the PNOL will be. It's an interesting thought when considering, weighing the balance between the effects of a heightened BAP as applied on, the tax due. But sometimes when you compare it to the increased benefits of the PNOL, you could find yourself in a better position actually increasing the BAP. So something to think about there for sure. And that, I guess, brings me to my second point, which is the statute of limitations to adjust the PNOL. Draft regulations have been issued by the department, and very recently, just last week, even an updated version of those regulations was released, for comment by middle of August. And they state that any change in the amount of unabsorbed NOLs must be made within the statute of limitations for the report on which the PNOL subtraction was first computed. So that would be generally 3 years from when the 2015 return was filed. Nearly all large taxpayers that I'm aware of have this period open by a waiver. So there's still opportunity to do this. The regulation also says that any federal changes that are finalized after the SOL closes, the statute of limitations, will not be considered in the computation of the unabsorbed net operating loss. That's a little different than anything we've seen in the past out of New York, since generally, federal changes are required to be reported to New York, and then would have an impact on the calculation on the New York return. The same general rules are outlined in regard to the base year BAP, but here's the catch. If the years are closed as per regulation and an error is later found, the PNOL can be recomputed for the open years, offsetting any amounts that were erroneously used in prior years. The department's drafted 3 examples where it paints a picture of an error on the part of the taxpayer, basically where a larger PNOL was used than was actually permitted. But the regulations don't contain an explanation or an example as to what happens when the PNOL should be increased beyond how it was originally computed, and if the statute of limitations is closed according to the regulation. But that being said, we think that there's room in the regulation as drafted right now that leaves open the option to also increase the PNOL, even if you take on its face the regulation, which says that you only have, a 3-year statute of limitations from basically the 2015 return. So really worth looking at. The next issue to think about, factor representation for dividends that are included in the tax base. It's kind of an age-old argument. There's nothing, brand new here, but it can be really helpful. Consider the use of alternative apportionment to adequately apportion dividends that are included in the tax base and otherwise don't have factor representation. When they're foreign dividends, inclusion in the denominator, which Dave had kind of previously mentioned in regard to thinking about the combined group, could have a really beneficial impact on the taxpayer. And last, I'll just mention again, we're not focusing on New York City today, but, I do just want to mention, since New York City and New York State have very different rules for the treatment of guilty, it's definitely an area that should be reviewed thoroughly before the statute of limitation expires, since it'll require a totally different calculation for the 2 jurisdictions that otherwise have pretty similar rules.
Yeah, so for New Jersey, I think the starting point is, like New York, there's a PNOL computation that goes off your base year business allocation factor. I think New Jersey has the same issues as New York there with computing your base year allocation factor. So there's a similarity there. And like I mentioned too, with the PNOL, your carryover period unlike New York, remains unchanged. So you don't revive PNOLs through that calculation of your base year allocation factor and then through the calculation of the PNOL itself. What I really want to focus on here is the treatment of dividends, though. So like Dave said, the majority of taxpayers in New Jersey, I think about 93%, chose the Water's Edge group. So the only dividends that really should be included in your group income would be dividends from foreign sources. And that's because generally intercompany transactions are going to be eliminated under New Jersey's combined reporting rules. Now we have the Supreme Court case in Kraft that says you can't treat foreign dividends worse than domestic dividends. So the question here is really, if the only dividends being included in group income as a result of the statute's elimination of intercompany transactions are those foreign dividends, should those be eliminated too as a result of the Supreme Court's decision in Kraft? I think we would say yes. The division may have some counter arguments there, but we think we have a good argument there too. If that argument doesn't work, there's also some friendly taxpayer case law on excluding dividends as non-operational in New Jersey. So something to consider there. We think all the case law, all the non-unitary, non-operational case law that's taxpayer friendly prior to combined reporting in New Jersey would still apply under the new regime because much of the statute on non-operational income remained unchanged. There's also the issue that Jen brought up with including any dividends in your tax base. So if you do include 5% of dividends in your tax base, 95% DRD, you should certainly include those dividends also in your sales factor denominator as well. There's a regulation in New Jersey that says that anything that you include in your tax base should also be included in your apportionment factor as well. And much of those dividends that are included are not going to be New Jersey sourced. So it really should provide taxpayers with an opportunity to dilute their apportionment factor. Given all of this, my vote on this, who wins, who's more taxpayer friendly, New York versus New Jersey, I'm going to go with New York on this one. And I say that begrudgingly because I like to focus much of my practice on New Jersey. But I'm still going to go with New York because of the historic NOL dividend rule that still applies in New Jersey. I think that's a big strike against New Jersey. What do you think, Jen?
Yeah, I think that's probably right. I mean, in some ways, I think these are regimes that are actually, somewhat similar between New York and New Jersey, but I think that New Jersey, dividend rules problematic, and I think that the PNOL treatment in New York is just, more favorable. I mean, we've got clients who, had NOLs that were about to expire, after years of sitting around, and they've got another, 10 plus years able to be used, and that's obviously huge. So unfortunately, when New Jersey, looked at New York for some of those rules, they didn't decide to take that treatment too. So, well, Aaron and I will take the win in New York.
So far we're at 2-0 New York. Looks like, New York's going for the sweep so far. Let's see if that continues. Next, we got credits. Jen, do you want to introduce some credit issues for New York?
I'm going to kick it to Aaron for this one, actually.
All right.
Okay, yeah. So for credits, New York has a variety of different credits available for use by taxpayers. There's the investment tax credit. There's what's called the qualified emerging technology credit. There's a manufacturing real property tax credit that's very much related to that zero rate that we talked about. There is something called the Excelsior Jobs Program, which includes a variety of credits. The most significant one is that we deal with the most is probably the investment tax credit. It's closely related to the manufacturing zero rate that we're going to talk about a little bit later. And many taxpayers that take the ITC credit also try to take the zero rate for the manufacturing credit. It is a 5% credit for qualified property that you can carry forward for 15 years. There's also a 20% real property tax credit. The Excelsior Jobs Program includes a jobs credit, also an investment tax credit, similar to the ITC above. There's an R&D credit separate for the Excelsior program. And there's also a real property credit associated with that. New York has fairly rigid standards, I think probably like most states as far as qualifying for a credit, but the credits available are pretty broad, and New York also has fairly broad carry forward opportunities for the credits that we're discussing.
Yeah, and on the New Jersey side, like New York, there's a variety of credits in New Jersey that you can qualify for. Some ones that we deal with routinely: manufacturing equipment and investment tax credit, AMA credits. Those are historic credits in New Jersey. I think for purposes of what taxpayers should look for, though, is when it comes to combined reporting, New Jersey, unlike the NOL sharing rules, you can share your credits throughout the group freely. So it's basically like a free-for-all. If you have one taxpayer that thought their credits were siloed, we're never going to be able to use their credits, and they're in a group with a taxpayer that has a large amount of taxable income, that taxpayer can share the credits with the other member in the group. So it's a very broad and taxpayer-friendly rule. And I know there's points on the next slide, but it's really not an exposure and opportunity. It's more so if you're a taxpayer and you're filing in New Jersey, you should really review your credit profiles, look at the credit profile of the group, see what credits you have available, and see where you can allocate and use those credits, because you can do whatever with those credits, essentially. So moving on to some exposures and opportunities. Aaron, do you want to discuss exposures and opportunities with New York?
Yeah, sure. So I mentioned the manufacturing issue. So what we're seeing, I guess, on the manufacturing side is both exposures and opportunities. So we've had, for example, clients that have taken the investment tax credit, and there's a couple different ways you can take that credit. You can take it based on by research and development, an R&D type computation, or a manufacturing computation. It also has a definition for manufacturing that's slightly different from the qualified manufacturer zero rate issue. So for ITC purposes, it talks about, as a definition for manufacturing, processing, or the process of working raw materials into wares suitable for use. And it goes on for there. But it uses the term process of working raw materials, which is more narrow than the qualified New York manufacturer definition that we'll go into a little bit later. So what you've seen, especially with the zero rate kicking in, we mentioned that tax reform happened in 2015. The zero rate actually became effective in 2014. We're seeing the state's auditors examining ITC credits and actually disallowing those in some cases because of the issue of it would add further support to the taxpayer's position if they want to take the manufacturer's zero rate tax rate position. So because the ITC is so closely tied to the qualified manufacturer definition, the state is scrutinizing ITC qualifications. To flip that, if you qualify for the ITC and the state agrees with that, you have a really good position as well that you can qualify as a qualified manufacturer, even though the definitions are slightly different. So that's why I say it's both an opportunity and a problem, in that we've had taxpayers that have qualified as manufacturers for years in New York. And now that there's such a great incentive in New York for manufacturers, that the state auditors are going back through to determine whether they truly were manufacturers and whether they were entitled to it in the first place. And they're doing that with the ITC credit as well. And we've heard and we've handled some audits with not only the ITC credit, but other types of credits in New York, with auditors coming in to more closely examine whether or not taxpayers are filing the proper forms and they have the proper timing and the proper documentation. So the exposure is really the state, based on budgetary concerns, really coming down hard on whether taxpayers are truly entitled to the incentives in New York, which is a little counterintuitive if the whole purpose of the incentives is to sort of increase taxpayer friendliness and increase investment in New York, to now use sort of more onerous auditing practices against taxpayers that are utilizing those, is sort of defeating the purpose of the incentives in the first place.
And I think we've seen that in New Jersey as well. We've had some cases where the issue was, are you entitled to the full value of the credit? And that's based on, some calculations within the credit in New Jersey. But one thing that I think I want to focus on here, especially because I think New Jersey needs a win at this point, is that in addition to the credits being freely shareable, we think there's some guidance in New Jersey that suggests if you conduct research anywhere, doesn't need to be based in New Jersey, you can claim an R&D credit. This would be a shift from the statute in New Jersey pre-combination, and it's really an opportunity for taxpayers. It's not explicit from the statute, but it's based on some division guidance, and it's really a taxpayer-friendly rule. So that, in addition to the freely shareable credits in New Jersey, I think that adds up to a win here for New Jersey. But I'm willing to hear any counter arguments you have, Aaron.
Well, before Aaron, I just to chime in there, and another thing about if you're conducting research in New Jersey, you can qualify for additional PNOLs, prior net operating losses. You can include 2004 through 2008 NOLs if you conduct research. So if you go back, take a look at what your NOL carryover was into 2019, if it only covered NOLs or losses from 2009 forward, and that entity conducted research and conducted it anywhere, we think you can include those prior losses in your computation.
Yep, and you guys are lobbying hard for New Jersey on this one. I
think I have on this one, Aaron.
And even to make it a little more onerous in New York, we've seen some recent cases where there's some TSBs that were taxpayer friendly issued in the late 90s and 2000s regarding the ITC credit in manufacturing, where the taxpayers qualified for those, and the department auditors are now saying that they're not following those particular TSBs, and the draft regulations that came out last summer, I think it was July of 2020, regarding qualifying for ITC credits in manufacturing, also sort of explicitly go against some of those TSBs. So they're not only auditing with more scrutiny, they're actually sort of pulling the rug out of some taxpayers that were relying on prior guidance, and actually have facts directly on point with respect to the prior guidance, and now the department's questioning whether they're entitled to the incentives and the exemptions. So this one could go to New Jersey.
I think we get the win there, Dave.
Right.
So now
let's keep it going with the next slide.
In 2015, New York moved to market-based single sales factor sourcing. New York now has 10 different categories of receipts. Some examples are tangible personal property, digital products and services, advertising, financial instruments, rents, royalties, transportation. There's then a catch-all category of other services. There's definitely variation as to what the market is among these different categories. In some instances, New York looks where the benefits received, and in some they look to the location of the customer. And then you've got other rules where they have a very specific rule as to where the market is. A hierarchy system's been delineated in the statute for some of these categories that create a set of ordering rules to apply when determining the location of the market too. The draft regulations do provide opportunity to overcome the presumptions found in the hierarchy. And the system being drafted is definitely intended to try and prevent there to be, a free-for-all of methodologies, and to try and really guide taxpayers to go through a certain set of rules as compared to, kind of leaving it open to figure out where the benefit is received, for example. One of the categories that has some unique rules are financial transactions. There's a whole subcategory of financial transactions that are outlined, all of which provide kind of varying rules. Among those are qualified financial institutions, or QFIs as they're kind of called for short, which refers to instruments that are marked to market under IRC sections 475 and 1256. QFIs are actually entitled to an elective flat 8% BAP. It's a special apportionment that, obviously favors New York banks, since it generally provides for a calculation lower than otherwise would be the case. And that was very specifically lobbied for it at the 11th hour before the 2015 law change was signed into law. Also not quite a special apportionment, but we are going to throw in here the 0% tax rate, that Aaron discussed as applied to New York manufacturers, qualified New York manufacturers, since it reduces the tax rate down to 0. Taxpayers who have more than 50% of their receipts from the sale of manufactured goods and who have at least $1 million of manufacturing property in New York are entitled to a 0 tax rate on the entire net income base, and then significant reduced rates on the other tax bases. This is obviously a huge benefit and incentive to New York manufacturing companies and manufacturing companies in general to think about their presence in New York.
Okay, so in contrast to New York, New Jersey is a lot more flexible. It also has a market sourcing rule, which went into effect in 2019. But even before that, New Jersey had been moving more and more towards a market sourcing based on the case law and just general policy. Under New Jersey statute, although the definition is benefit received, there's an awful lot of flexibility baked into it. So we'll talk about how you can use that to your advantage. We'll also talk about some opportunities involving special apportionment. New Jersey still has, allowances for equitable apportionment if you meet a certain threshold, and there are special apportionment rules for certain types of industries like transportation companies and investment companies. So moving on to the next slide, what do taxpayers need to think about, Jen, with respect to apportionment?
Yeah, so high level, and probably the first general thing is that, while New York's created these hierarchies and presumptions around sourcing methodologies, there is, flexibility, as a little, vision into where this one might come out. I don't think there's as much flexibility as there is in New Jersey, but there definitely is to determine, to some extent where the market is for, various revenue streams. We have seen multiple drafts of these regulations come out over the past 3 years. The most updated version includes the ability to use reasonable approximation, which is based not only on taxpayer and customer information, but on publicly available information such as population data or really any other data that's available. And I won't steal your, Dave, and Matt's thunder, because you guys, have really kind of perfected the art, but there is so much big data out there, either stored within the company's data or publicly available, that could really be potentially used to reduce taxpayers' BAP. The regulations out there too, important for everyone to remember, as with all of the New York regulations addressing corporate tax reform, they're only drafts and they're constantly changing. When you talk to New York State, they say that, they're not binding. Of course, they're going to rely on them to the extent that they like them. And we can do the same. So if you like them, use them. But if you don't necessarily have to, especially when it comes to sourcing, since there's been so many versions over the past few years. We have clients who found that guidance in a prior draft is more favorable as compared to a more current draft. So, it's a smart thing to, at the very least, check in on the different guidance that the state has contemplated over the past few years, and cherry pick the best option right now, certainly before anything becomes finalized. I can't think of a better support that it's potentially a correct interpretation of the statute than the department putting pen to paper on it on their own. Some specific opportunities, the 8% election for qualified financial instruments, obviously favoring in-state financial companies. There's a great argument that the provision violates both the internal and external consistency clauses of the U.S. Constitution. This also holds true for the flat 8% apportionment that's applied to some other financial instruments. We've come up with kind of multiple ways to try and seek to fix these issues. Some of them are to potentially remove them from the numerator, and that can be kind of especially compelling if they're otherwise sourced to the state of commercial domicile and not that they wind up, in no state's numerator, but also potentially just applying a different market-based rule altogether or, an MTC formula. So different things to think about in particular if you are, an out-of-state financial institution and feel like, the 8% rate, isn't benefiting you. Last and not least, there's a lot of opportunities and considerations, as Aaron kind of teed up, in regard to the zero rate that applies to New York manufacturers. Think about if your industry and business can fall within the statutory meaning of manufacturing or processing. There's some great issues that we've been handling regarding whether digital products are manufactured, notwithstanding that there may not be a tangible output from the manufacturing that's done, whether various medical treatments are considered processing. The benefit is just so significant that it really is worth thinking about, even if you haven't, filed that way in the past, when there was still a reduced rate for New York manufacturers, but not nearly as beneficial. New York doesn't peg the definition to, an NAICS code or any other black and white criteria like that. So there's some opportunity. If you're in the business of manufacturing and processing, but not in New York, it's definitely worth considering relocating manufacturing property into New York in order to qualify for the reduced rate. If you've got any meaningful New York tax liability, the benefit could pay for, the expense very quickly. But, if doing so, you got to consider whether the property is owned or leased, what exactly it's used for. The statute isn't really explicit on whether leased property will qualify. So some considerations to be given there. Another related issue, taxpayers can run into hurdles regarding property that's used by independent contractors or agents, via third-party contractors. The department's issued guidance saying that third-party contracting doesn't qualify, but there's some good case law and, old advisory opinions that were issued by the department, which suggest otherwise, so long as there's adequate control over the third-party contractors' activities and facilities. Third-party contracting is also an issue and can come into play when determining if the taxpayer is actually in the business themselves of manufacturing. Think about what activities you may actually do on their own that may be part of the manufacturing process. Maybe there's a significant amount of quality control and related activities that can actually be considered manufacturing on your own, as compared to having to look to the third-party contractor to meet the definition. And then my last food for thought on this issue is in regard to the receipts tests. To be a manufacturer, a taxpayer has to have more than 50% of their receipts from the sale of manufactured goods. A real wrench can be thrown in this analysis if the taxpayer makes sales of assets out of the regular course of business, or otherwise receives receipts that it typically would consider to be non-business income, even though New York doesn't really use that phrase. There's no statutory exemption to exclude these receipts from the analysis. So taxpayers, should be thinking about this impact, prior to making, I'd say, these, unique sales. But if you find yourself in the situation after the fact, there are some arguments to be made, from a policy equity standpoint in regard to considering if you can, overcome the footfall and still be considered a qualified manufacturer. So a lot to think about there. And, as Aaron mentioned, we're really seeing this issue, come up a lot. Taxpayers that even, historically treated themselves as manufacturers and got a reduced rate. The state is all over this. The benefit is just so big that, they're not letting it slide by, but there's also a lot of taxpayers that I think can, qualify for this benefit that weren't thinking about it in the past either. What about New Jersey?
Yeah, so New Jersey and New York both share some of the same statutory language. The test for sourcing services receipts is benefit received. They use the same language of reasonable approximation if you don't know where the benefit was received. But there's a lot more flexibility in New Jersey, despite kind of the superficial similarity. In particular, in our view, even if you know exactly where the benefit was received, the rules provide you with the flexibility to use a reasonable approximation in spite of that. And as Jen mentioned, there's lots of great data sources that you can use to come up with a reasonable approximation. We've had lots of clients that have been doing market sourcing a certain way for other states, and when New Jersey adopted market sourcing, they applied the same sort of test. But when we compare that to some of the data that we were able to obtain from the public domain and the taxpayers' own business records, there was significant differences. Some sources of data from third-party sources can include Medicare data for healthcare companies, data from FERC for energy companies, financial reporting data for financial companies, any sort of industry data can be used, even population or GDP can be used as a proxy for where your market is. So if you're just kind of doing the same thing you're doing in other states, it's worth taking a look at some of these alternatives for New Jersey purposes. Another opportunity is, under the plain language, unless your customer has a brick and mortar office with a full-time employee working in the state of New Jersey, then by definition, your customer can't receive any benefit from the services you provide. So this can become important, as your customers may be working from home. If they don't have their own office in New Jersey, then you don't have to source any services receipts to the state. Historically, New Jersey, used to have three-factor apportionment, wasn't market sourcing. So you'd see the division or courts say, look, you've got essentially no property or payroll in the state. We're going to use a market factor, include a market factor in for your receipts, just so you have some tax liability given your income that's derived from the state. Now that we've flipped single factor with market sourcing, I think taxpayers can use that same guidance and turn it on its head. So if the only thing that's reflected in factor now is where your customer is, then it seems fair, based on that old guidance, to give some credence to where your property and payroll is. Where were the activities performed to generate those receipts? You can't just ignore those based on that old guidance. So if you've seen your apportionment shoot up as a result of single factor market sourcing, you may be able to claim alternative apportionment for that. As far as other alternative apportionment issues, Matt, do you want to address some of the potential opportunities for taxpayers?
Yeah, sure. And quickly before moving over to that, I'd say on your point about New Jersey GDP, don't source service receipts greater than what the New Jersey GDP is. The reason taxpayers should follow that is really because the division has done that to taxpayers in audit. When there's not enough information, the division has used New Jersey GDP as a proxy to source service receipts. And in addition to that, in some of the division's guidance that it has published since combination became effective, New Jersey has used GDP as a proxy for certain items like GILTI. So GDP seems to be a reasonable approximation of service receipts. So I think it's a good opportunity for taxpayers if you're sourcing your service receipts higher than what New Jersey GDP would be. As far as other special apportionment opportunities, we had listed on the other slides REITs, RICs, and investment companies. I think the biggest opportunity here may be for investment companies. And what an investment company is in New Jersey is if you have investments of more than 90% in pass-through entities, you qualify as a New Jersey investment company. So if you're domiciled in New Jersey, what that means is you get a 60% tax reduction, essentially. What the statute says is if you're an investment company, you source 40% of your taxable net income to New Jersey. That's what you do. You just take your taxable net income and apply a 40% rate, and that's your tax. The question really is, what do you do if you're a multi-state investment company? Say you're a multi-state company that has more than 90% of its investments in pass-through entities. Now, the New Jersey-based company is certainly getting the benefit by taking their 100% apportionment and then cutting it by 60%. The multi-state company, probably not so much. Our guidance here would be that not only do you take your taxable net income, multiply it by 40%, but in addition to that, you multiply by your multi-state apportionment. So your service receipts apportionment, single factor apportionment in New Jersey. And that should provide an additional benefit for investment companies. Now, the downside to some of these other special entities apportionment in New Jersey, intercompany transactions aren't going to be eliminated. So say that your group would generally include an investment company, a real estate investment trust. Those entities are not part of the combined group in New Jersey, so you're not going to eliminate intercompany transactions. So if you have any intercompany transactions with those types of entities, you should really analyze the tax effect of that to see if it's beneficial to have those types of transactions or it's not. I think we've seen it both ways, where it could benefit some companies and where it could hurt some companies. So there's definitely some considerations around what we would call special types of companies in New Jersey as far as real estate investment trusts or investment companies. And I think there's pros and cons to having those types of entities in New Jersey.
So as far as, which state has the, the more taxpayer friendly rules, now I think this one is split. With respect to market sourcing, I think New Jersey's flexibility makes it very taxpayer friendly, but, you just can't overlook, the 0% apportionment rate that manufacturers get in New York. So, I think with respect to, the general sourcing rule, New Jersey wins. With respect to, special apportionment, New York wins. So now we've got one last topic to go through, and that's partnerships. Okay.
So partnerships, just quickly, partnerships don't have a lot of crazy rules in New York, I think, compared to some other states. Tax attributes are accounted for on an aggregate basis. There were some changes with the 2015 tax reform legislation regarding partnerships creating nexus for corporate partners. There was prior to 2015, there was at least for state purposes, there was a limitation on creating nexus. If you're a limited partner, you needed to have at least $1 million basis or more than a 1% ownership. So there was sort of this safe harbor where a limited partnership would not create nexus for New York. That's no longer in place. You also have the New York City unincorporated business tax, which is a tax explicitly on flow-through entities. So you do have taxes on partnerships in New York City, at least, that can, if you're doing business in New York City, it can certainly create a more onerous tax regime compared to some other states. And actually, just recently, with the budget from March of this year, 2021, New York did pass a New York State pass-through entity tax election. This is just for individual tax credit, but what it is it allows a taxpayer to pay tax on the partnership for New York State purposes if you make the election, and then take a credit of the tax paid based on your proportionate share of the partnership income. And it's really the reason for that, and I think some other states have passed taxes like this too. I don't know if New Jersey has. New Jersey might have. But what it does is it's basically a workaround for the $10,000 limitation on state and local tax deductions for individual tax returns for federal purposes. So it's a credit that can be applied for personal income tax to work around that $10,000 limitation.
So as far as New Jersey goes, historically, there were some lots of litigation regarding whether an investment in limited partnership was subject to tax, distributive share was subject to tax at all in New Jersey. And there's some very taxpayer-friendly case law. There was also some case law that went the other way. Along with combination, New Jersey instituted a bright line test. If you have 50% or less of an interest in a partnership, limited partnership, then by definition, you're going to be non-unitary. And so, the treatment of your distributive share will depend upon that ownership interest. As far as, issues and opportunities, Aaron, anything you want to touch on for New York?
Well, just a few. There is some separate accounting guidance for New York. This was actually a New York City tax appeals tribunal decision from 1998, where they allowed a taxpayer who had nexus with the state through a limited partnership that was operating in the city to use separate accounting. And this is a company that had a confectionery business, Just Born Inc. And even though they had nexus with New York through the limited partnership, they allowed the confectionery business, which was based outside of New York, to use a separate accounting and basically not subject that separate business to New York tax. And the taxpayer was only subject to tax in New York based on its partnership activities. There's some special sourcing rules for gains and losses from real and tangible property, where that type gains and losses from those types of property are allocated rather than apportioned. And that can become relevant in certain cases. There's a case from 2014 in New York State, the Olsham case, where a taxpayer had income from real property that was allocated to New York, but when it sold the building and had an intent, or actually it sold the partnership interest holding the building, it was considered an intangible gain, and that actually resulted in a loss. So it had a loss on the sale of the intangible, but the city did not allow the taxpayer to offset the income which was allocated with the loss, because one was from income from real property, and the other one was from the sale of an intangible. So that sort of hurt the taxpayer based on those special apportionment rules. And then I mentioned, there is an opportunity for individuals for the state and local tax deduction to take this new pass-through entity tax election beginning January 1 of this year.
In New Jersey, I think having this 50% interest bright line test to determine whether you're unitary or not is actually pretty taxpayer friendly. It's nice to know exactly where you stand. You have a bright line test. But in addition, if you're a 50-50 joint venture, there's a position that none of your distributive share is taxed by New Jersey at all. Rather than flowing up any income receipts from the partnership, or using a separate accounting approach to apportion your distributive share using the partnership apportionment factors, you can take the position that you allocate your distributive share entirely to your commercial domicile. So if you're based outside of New Jersey, that distributive share can escape New Jersey taxation completely. So that can be a potential huge benefit. Again, it's a position. If you follow the return instructions, that's not what the return instructions are going to provide, but we think that's supported based on the general guidance and statute. So given that bright line test and the potential benefit of excluding that from your base, I think New Jersey gets the nod here, with respect to the partnership issue. So, I think we can take a look at our scorecard at this point in the next slide and see where we end up. And so the way we've scored it is essentially a tie. And, we're curious to see what the audience thinks. So we encourage you to vote accordingly. So how are we going to break this tie? Who wants to start? Jen?
Sure. I'm going to stay loyal and stick to New York. Look, I mean, it's been 6 years and we still don't have, much formal guidance as to how the statute's to be interpreted. To be fair, to no fault of the department, between handling corporate tax reform and then federal tax reform and then the impacts of COVID, a lot of the audits are still at the beginning stages as well. So truly, there's not a lot of, formal guidance that's out there. But I do think that, that leaves open a lot of opportunity. And, if you put in the time to try and see where those opportunities are and how they could benefit there is a lot of room for taxpayers to, come out with a good result. And they definitely did some things as part of corporate tax reform just to simplify, the tax structure overall. So I'm putting my tie vote for New York.
Matt, how about you?
I'm going to stay loyal too. I think when you look at what the Division of Taxation has done over the past couple of years, they're doing their best to administer a statute that I think you, Dave, had called basically like a Frankenstein a couple times, because you have pieces from other state statutes just pieced together into New Jersey.
I don't remember saying that exactly, but go on.
But I think what the Division of Taxation has done with that is they've been very approachable from the taxpayer administration standpoint. I know over the past couple of years, there's been more than a couple of occasions that the division has sought guidance from taxpayers, from practitioners on how to make their statute work, what regulations they should pass, and generally what guidance they should put out for taxpayers. There's a continuous amount of guidance that the division has put out over the past 2 years in the form of technical bulletins to try to help taxpayers. I think the division is doing the best that it can. And I think we've seen throughout this presentation too, there's a lot of opportunities out there for taxpayers. I know one of Dave's favorite topics is sourcing. Sourcing has always been flexible in New Jersey. It's still flexible. And I think with credits too, it's anything goes. I'm going to stay loyal with New Jersey. And I think the Division of Taxation has a say in that too, just from how they have administered their statutes and regulations.
All right, I'm going to break the tie. New Jersey wins. And here's why. if you're doing business in New York, likely doing business in New York City as well. And, you know, who's got the highest tax rate, combined tax rate in the nation? Not even close, right? New York City, New York combined. You got to give it to New Jersey, given that. You guys okay with that?
I think that's right. Yeah, when you consider New York State's tax rate of 6.5 or so, varied by year, New York City another 8.8%. Then you got the MTA surcharge on that. You're looking at 16, 17% effective tax rate, which is very high. 35% higher in some cases, depending on your business operations, than the next highest state. So, yeah.
Okay. So, and in case you're, yeah.
You know what? Did you forget about the New Jersey, surcharge? At least New York's kind of out there and straightforward with, our tax rates.
Well, surcharge is only temporary. I still think New Jersey wins, but that's fine. Everyone's entitled to their opinion. And in case you're wondering who would win if King Cobra battled a kimono dragon, no contest. Kimono dragon loses, King Cobra wins. So we'd like to thank everyone for tuning in. If you need more information, there's some links here. If you want to download our New Jersey Survival Guide, we encourage you to do so. And certainly if you have any questions or would like to talk about your situation specifically, feel free to email or call any one of us. Thank you.